Welcome, everyone, to Name Confidential Live.
Thank you, Susan. Yes, welcome everybody to Name Confidential. Today, we're joined by Art Molloy, a seasoned investment manager with over 45 years of experience in financial advising and asset management. Art has built a 700 million AUM firm by focusing on strategic adaptive investment models while prioritizing long-term client relationships over short-term performance metrics. He's an active contributor to the NAAIM Exposure Index and brings a wealth of insights into tactical allocation and the evolution of investment strategies over time. Art, great to have you here.
Thank you, Kenton. Appreciate that.
So as we do, let's kick it off and take a look at our NAAIM Exposure Index. As of yesterday, February 20th, we are at 91.48, a jump up from last week. Any notes or reactions to these numbers, Art?
Well, I like to use the index exposure, the exposure index numbers as a reference tool. It does kind of give the weighting of where the membership positioning is styled. And right now, and you can see that's a graph from the beginning of 24 through last week. And it's stayed elevated in the 80 range, plus or minus 20 points, pretty much throughout the last 14 months, which is a bullish position overall. So if you look at the chart below that, you can see that the S&P 500 index has kind of gone on a, bottom left to top right corner move with a gain of about 1,200 S&P points, maybe 1,300. And that represents a nice, healthy gain. So the membership has stayed fairly bullish, and I think that's where it should be, given how the market has behaved. You will notice that when the index gets up to the extreme readings, it does tend to coincide with short-term market tops, and vice versa. The lowest readings do tend to coincide with short-term bottoms. Overall, I know that some other observers will use the NAIM member index as a contrarian indicator because of those short-term elements.
Thank you, Art. I appreciate the context there. And thank you for your consistent contribution. I think you are among our Diamond Club members. Susan might be able to tell us what to qualify for that, but you have certainly been an excellent contributor over the years. Thank you so much.
Well, thank you. And I'm waiting for my diamonds to come in from Susan, but I think the shipment is lost somewhere out there in the mail.
Price of diamonds has been coming down. If you see how much writing off the De Beers acquisition has been done by Anglo American, but maybe that's a little too much in the weeds. Yeah. In our prep for this call today, we talked about some of your background and experience, and I think one of the ones that is particularly interesting is how you transitioned from a financial planner to an asset manager. What was that like?
So I started in the business in '79 as a financial planner, helping individuals with their finances, usually all-encompassing from life insurance, retirement planning, tax planning, estate planning, etc. And more, there was an accumulation of assets under my stewardship, and I had a growing concern for loss of capital. So I began to develop what was then known as a market timing indicator that I could utilize and shift assets out of risk into risk-free areas when challenges or challenging circumstances seem to be developing. And so I began to charge a fee for that service in 1987, and it was essentially just a mutual fund market timing between equity funds and money market funds. And fortunately, we were able to sidestep the horrendous crash of the market in 1987, and our clients were in the money market fund as of mid or late September of that year. So when early October showed up and the market crashed, our clients had held on to a 25+% gain, and we were able to reposition them the following February. It took a few months for the market to settle down and for us to get indicators, signals to go back in and reposition them in equities. So once we had that under our belt, it gave us the confidence to market the service more, and it also fueled the flames or fanned the flames of referrals. And the referral business was very welcomed, and it was very good for basically the future. So I had a CFP designation that I obtained in 1986, and I decided to work on my CFA designation starting in 1987 and obtained that in, I think it was 88. I started in 88. I obtained it in 1991, 3 years later. So I have the CFA. And then later in 2006, I decided to get my Chartered Market Technician, my CMT designation as well. And so with the CFA and the CMT, we've utilized both fundamental and technical resources to develop our tools that we use for clients.
And so, I mean, this indicator that you was able to get your clients and avoid this 87 crash, are those technical indicators ones that you're still using today, or how have markets or how have these indicators changed or adapted as regime perhaps has changed over time?
Yeah, that's a great question. And the answer is no. The systems we used back in the late 80s, we ended up enhancing those and deriving a series of timing tools and work with those in concert with one another. They come from different perspectives, different resources that we're looking at. So we now use 5 primary indicators, and we will move 50% of our money out of equities when we get 3 of the 5 to trigger a sell signal. And when the 4th one triggers, we'll move that other 50% out. And then vice versa, we need 3 buy signals to trigger 50% back in, and the 4th one to get the next 50%. So the primary indicator that we've used over all these years is the advanced decline line. We now use an operating company only advanced decline line because of the proliferation of ETFs and fixed income funds of all types, preferred securities and the like. So we had to filter those out and just look at what operating companies, what that advanced decline line looks like. And we use a 200-day moving average with a filter around that to trigger our buy and sell signals. And I will share my screen and show that chart. We use stock charts for this. So hold on, I'm sorry. I did not turn on my do not disturb, which is now on. So this is the chart that we use. It's our charting service. It's stock charts. It's the advanced decline line for common stock only. The blue line in the center is the 150-day moving average, and the band around it, the red lines, are our sell and buy indicator lines. So we will buy on a penetration of the upper band, and we will sell on a penetration of the lower band. And again, this is just one of our 5 indicators. So this, you can see there was a sell signal in November of 23 and a buy signal in December. Very whipsawish, but fortunately for us, this was not an indicator changing any of our positioning at that time. So it's good to have multiple resources, because if I had only one, I might be fairly disappointed with how the one is operating, because I find that most indicators work most of the time, but they don't work great all of the time. So the way we've got it set up, I feel very comfortable that we will escape most of major bear markets, with the exception of a COVID-related instant recession. And that market decline, we did not get any sell signals until 2 or 3 days before the market had bottomed out in March of 2020. And that was the only time in recent memory, and when I say recent, I'm talking the last 20 years, that I can remember that we purposely decided to ignore a signal.
So looking at the time frame of this chart, it's dancing all over this top red line for the entire of 2024, it looks like here. Is it safe to say that during this period you were fully invested?
Yes. We have stayed fully invested throughout. We've made transitions in some of our holdings, and during those transition periods, we will temporarily have a lower equity exposure. But basically, we stayed fully invested for almost all of the second half of 23, well, all of 23 and all of 24, I believe. I'd have to go back and check our records, but we had, pardon?
Go ahead, pardon me.
No, I was going to say we had buy signals in at least 3, 4. I believe we were in almost all of 23. There was a short period that we went back to cash. But yes, all of 24 we were in, and we continue to be fully invested here in 2025.
So looking into the future, dovetailing off of that, how close are you to any of your 3 of 5 signals or 4 of 5 signals today?
I'm not close at all. We have no negative signals at this point. And so even though, and we shouldn't, the market just reached an all-time high earlier this week. And despite the last couple of days of challenges with markets being off, that's a normal process. As you saw, 2024, there were several short period sell-offs of anywhere from 3 to 7 or 8%. And we consider those just normal noise in a bull market.
And when you start with one input here, right? One metric that you're following, what was the time frame? I mean, it sounds like it was really over this 40-year plus span where you went from 1 to 5. But what did that look like over that period of time when you were starting with 1 and then growing up to the 5 that you're focusing on now, Art?
Well, that was technology would be the major driver.
Okay.
Some of these indicators and processes we're using today are much easier to have available with the advancement of technology over all the years. When I very first started following the stock market, I had a piece of graph paper that I used with X's and O's. So point and figure charting was what I was using in the 70s for my own investment accounts. And where that was very effective, it was also very easy because unlike today's world, which moves in a millisecond, back then, the information I was using to put my X's and O's on charts came from the Wall Street Journal that I got today. It had yesterday's information in it. So certainly things have advanced a lot, and it includes the accessibility to more comprehensive, robust information. And as electronic technology has improved over the years and the speed at which things can get processed, we added more and more to our signaling process. And I can't remember the exact transition, but we did use a couple of other indicators that we, at a later point, decided to cast aside and just use them as reference tools.
Right.
Some of those include looking at the number of 52-week new lows being made in relation to where the market is off of its high. And we have that indicator today telling us there are troubles today because the number of 52-week new lows has been expanding while the market was making all-time new highs earlier this week. So we have reference tools of that nature. We also use a 13-week versus 34-week exponential moving average for the S&P 500 index to identify where the trend in the market is, but we don't use that as a primary signal. Hope I'm helping people out there.
And are there any surprising data sources that you use as inputs for any of the current signals that perhaps were not available or might be considered alternative data sources available today?
I think all of the resources that we use today would have been available at least 25 years ago. It's just the accessibility to them and the processing of the data to get them is a lot quicker. And I have everything at my fingertips, and I know when anything is going to change from a buy signal to a sell signal. And we don't have any indicators that go to some halfway house. Everything is either black or white or, red or green, or however you want to look at it.
Binary, yeah.
Yep.
So you mentioned most recent case study where it hadn't worked as well, which was coming up into the COVID correction. So what did that look like for you, and how did you kind of grapple with having to step away from your model during a time of really serious turmoil and uncertainty in the market, and then be able to come back with a conviction to kind of re-implement it when you saw markets normalize? What was that like for having to be able to step away and re-engage as you've done today?
Yeah, that was, as we all think back 5 years ago, it's almost 5 years to the day. It seems like that things were starting to go haywire with COVID. None of us had ever lived through a pandemic, and I didn't really understand the impact or implications. And, going into that, had I might have taken a preemptive move and gone to cash on a fundamental basis. But that was a situation where it seemed like so much had been taken out of market valuations over a condition that seemed to be likely to dissipate in relatively short order. So when prices of equities get taken down 30+% in a matter of a couple of weeks, from not a very overvalued level, now it seems very undervalued and very wrong to take action that would result in real risk being realized, meaning risk is the permanent loss of capital, as opposed to the volatility decision that we made, which is, hey, yeah, this is a really volatile world all of a sudden, but we need to hang in there and accept a little more upside potential to see how this plays out. And we were glad we took that position because it did benefit our clients. We did make strategic moves, and those moves allowed us to have a better than 20% return on our equities that year. So we were very happy with the outcome we were able to realize. But I will tell you, it was the most difficult decision to go against every indicator, our whole system, because I don't want to have systems that I have to think about. I want them to be all automated and, like you said, binary. We're either in or we're out. And we do have this 50% in between model that does allow us to transition. But yeah, it was a challenge, and I wouldn't want to have to go through that again. And I'm not sure I would make as many good decisions again as I was able to in 2020. It's just, one of those situations where you're trying to do the right thing, the best thing. And fortunately for us, it did pay out.
One thing that stuck out about what you said here, Art, is you're saying, all right, well, if I had looked at some of the fundamental indicators ahead and had an opportunity to be able to move into cash, I'm wondering, was it the gut? Was it the experience? Were there fundamental indicators outside of your quantitative one that helped you navigate or be able to have conviction in navigating your clients through that time and allow you to ignore your typical indicators?
I think what our indicators are designed to to tell that there is an upcoming economic recession that's going to have a significant impact on businesses and business valuation. So it requires a certain amount of time for the indicators to trigger. And the pandemic caused such a very compressed time period for a recession to develop and for markets to price that in. It didn't allow our indicators to have the time that they are required under normal circumstances. So
Right.
this being such an abnormal world of an instant virus-based pandemic globally, that was just such a unique experience. And if we were getting everything compressed in time, the thinking was we'll probably come out of it very quickly as well. And yes, I think some of it was luck. There's a certain element of luck. We were fortunate that we were, had our wits about us and decided that at that moment in time, our indicators were not going to be valuable tools, and we needed to use our best instincts and experience to figure out what path to take.
And to understand that there's a certain time series that's required in order for your indicators to be effective. And
Yes.
so if that time series is not going to be an input in order to get reliable indicators, that's when you have to switch to experience or luck, or won't paraphrase it too much. Well, I think, another thing that stems from this, and, let me know if this question's not terribly clear, but I think about, when you have the experience that you have, and, we're just stepping out of an environment of zero interest rates. I'm talking about going back to 2009 and basically free money, or TINA, however there is no alternative type of mentality. And we're starting to see interest rates start creeping up. And, I always see this as a regime that's much more opportunistic for stock picking, because it's not everything's just up and to the right in the regime of free money post GFC. How do you feel your indicators may or may not adapt to the free money environment? And are you looking back at the time series of more normalized interest rates to tweak your indicators to go into the future from today, as we have interest rates and money isn't free anymore?
Yeah, we don't have any indicators that were sensitized to the free money environment or
Okay.
the low, zero interest rate environment. We do manage both equities and fixed income, and there are different models for each of those elements. And the fixed income side was very difficult from, post GFC until the last few years. And finally, we've seen interest rates come up to a more, I'll call it normalized level.
I agree.
Because I think for 15 years it was abnormal.
I agree.
And now that we're back in the normal zone, the fixed income models can go back to kind of more traditional for what I had set up back in the 80s, 90s, and 2000s. And the equity model timing systems they're not tied to interest rates or interest rate models. They are independently looking at what's going on within equity markets. And I think what happens within the equity market is driven by what's happening in the bond market, the fixed income market. Fixed income market is larger in sheer dollar volume than the bond market is globally. So I think you can't have one of those markets. I don't want to overemphasize, hey, now interest rates are high, therefore PEs must be lower. And where I do have that in my CFA brain, my CMT side says, yeah, but you're going to have to wait for the market to tell you that change is really happening.
Yeah, I think that's the one thing that I struggle with is applying kind of pre-GFC valuation techniques or models into today's environment, where I agree with you, is a more normalized environment, is just this, average PE ratio seems to have stuck with the new amount of either, empty money supply or just demand for US equities globally, where you have this really persistent average PE, where you're saying, hey, if I was going to go back to my value investing or my CFA hat, it's hard to pick up cigar butts like early Buffett or Graham and Dodd, using the same sort of hey, how do I benchmark what is an appropriate price to pay, either for a broad set of equities, or what would be more accurate would be a industry specific PE multiples. So how do you grapple with the elevated PE, the stickiness of elevated PE multiples over the time frame that you've been in the market?
So when I first started in the markets, or financial planning, interest rates were in the double digits, and market PEs got down into the single digits. So I've gone from high single digit PEs to expanding all the way into the mid 20s, and kind of back and forth, as everyone has experienced. And so what I try to make sure I don't do is anchor my brain to some prior point in time and say, well, that's the way it should be, because times have changed. It's like what I told you about how I can use more indicators, I get more robust information, I get it more real time. All of that has everything to do with technology, and technology does drive greater efficiencies. And unlike our distant past, where the United States was the biggest manufacturer in the world, we're no longer manufacturing much of anything. And manufacturing is a capital intensive process. And when you invest a bunch of capital in that way to manufacture goods or products of some sort, you are depreciating that investment in capital over time. And so your earnings are always impacted as you're producing from that factory. Whereas if you're creating, a semiconductor chip, you're writing off every dollar of expense as you're developing that chip. But once you start stamping them out and producing them and getting paid for that, there's no overhead, technically, or there's no R&D expense that's getting amortized over a long period of time. So earnings are more pure today. So if they're more pure, we should have a higher value to those. And so I accept that readily. And I think if you're still a manufacturer and you're still making, vacuum cleaners or dishwashers or whatever you're manufacturing, your company should not be worth the value of a company, say like Adobe, relative to earnings, where Adobe's creating a software product that you pay a subscription to obtain, and they spent all the money developing that product in the past, but there's no ongoing depreciation that they have to expense. So anyway, I think it's just accounting and methodology and how times have changed.
Well, you've got the joke about, the last thing EBITDA sees before it gets adjusted, and you see army of people in Patagonias and blue button-down shirts. And it sounds like that you're more of the adjusted EBITDA camp than the latter. But I think we're bumping up to the top of the half hour. One way that we typically close off our Name Confidential is with a quote. Art, you have any words of wisdom for us?
I do have a quote, and this did come up in my personal past, and that is that I've never learned anything by making money, and I learned everything when I lose. So my first trade as an investor back when I was in college, I made an 1,100% return on an options trade. Over the course of the next 3 trades, I lost about 70% of those profits. So I don't think I learned enough on the first trade, but I did learn a lot more on those next 3.
Well, I can't wait to hear a little bit more about that. Are you going to be down in Costa Mesa, California in what is it, May 5th through 7th?
I think I was one of the first ones to sign up. I've already paid for I've booked my hotel. I'll be driving up and out of San Diego, and I am looking forward to that conference. So yes, I'll be there. It's May 5th, I think.
Yeah, that sounds right. 5th through 7th.
I think. But yes, I'm all booked, ready to go.
Well, sensational, Ari. I look forward to seeing you there.
All right, thanks. I appreciate it, Ken.